Hey folks, hope you guys are well today. So in today's video, I wanted to explore the concept of order flow trading. Where's the edge in order flow trading and why it's important? And I just basically want to explore with you some of the basic concepts in regards to this approach of looking at and understanding the markets. And this applies to any market, it doesn't apply specifically to futures or anything. So let's get to it right now, guys. If you're new to the channel, don't forget to hit the like button and check out some other videos on the channel. We've got a lot of tutorials on certain trading platforms and that. So let's get to it right now. So what you're looking at right now is a platform that I use every day, which is called Jigsaw Trading. And I want to explain to you why I use this platform and basically what advantage it gives me as a trader looking to seek short-term opportunities from this market. Now, generally, let's get to the bare bones of it. All right, so the majority of new traders when they get into trading, and first of all, I do want to say that this video is more intended for beginner traders, guys getting into this, not necessarily experienced traders, because you guys already know this stuff. So the majority of traders when they get into it are looking at chart patterns. So they look at the chart, they see approximately where the buyers take control, approximately where the sellers take control, but they're not necessarily seeing the deeper picture. They're not necessarily seeing the orders hitting the market that are affecting the price. Now, again, this could be a questionable topic, and you could say, well, do I really need to see all of these orders? And you could make an argument that you don't. However, in a lot of cases, depending on your trading time frame, it is important to, in fact, see what is going on and how the price is reacting to certain orders that are trading into the market. All right, so as I was saying that, you saw that my tape got pretty red there and the price in fact moved lower. So that is notable. It means that the price moved lower on sellers. Now, that doesn't always happen. Sometimes sellers hit the market and the price doesn't move lower. Basically, those two things are completely different and they need to be noted when you're scouting for a certain opportunity, that is. So why would you look at the markets in this way versus just a chart? Well, it's pretty self-explanatory, but I just want to explain to you the basic concept of it first. So the first thing you need to understand is volume at price. All right, so on the left side of the screen, you're looking at a volume profile. That's what volume at price is. And it basically shows you how much volume has traded at every price point. Now, the reason this is important, you have to view it from the perspective of an institutional smart money trader. These guys have the ability to move the market any which way they want at any time they want. Now, if they want to profit, because their goal is to profit, they're not just going to move it at any moment. They need to use their tools necessary to make sure enough traders are on the wrong side of the market before they move it against their positions. And then the market has an easier time moving in their profitable direction, right? So I'll give you the example. If they want the market lower for whatever reason, they have a hunch that there is some liquidity below a certain point, they can use their tools necessary to kind of give the market the impression that the market is not likely to break the low. And they can do this by using a number of tools. Like pulling the offers, for example. They will essentially move the offer up. You'll get some of these like impulsive bullish moves. They will generally use their tools to fool traders into taking the wrong side. And when every chess piece is in play at exactly where it's favorable for them, that's when they start initiating some positions to get the market moving. And then the rest sort of unfolds in a very simple way. So if enough people are on the wrong side of the market, generally it's going to have an easier time moving when those positions are being tested. That is, there's a certain cost associated to the institutional trader to hold the market up for a certain amount of time. But once the market reaches that level where all of the liquidity is trapped, the market specialist essentially doesn't have to do anything. He just has to actually have a limit order in to take profits on some of the position and then just kind of let the market do its thing, because the specialist knows, or he has a hunch where there is likely to be traders panicking into or out of positions. So what am I getting at with all of this? Well, I'm getting at the fact that you can't really see this stuff just by looking at a chart. And maybe you could make the argument that you can, but I will argue that you can't. Because you can't see how many orders are trading at each price, and how is the price trading around those prices. That's what you see when you look at a price ladder like this. So you can clearly see the behavior of the price and the tape, and you can clearly see how it moves up and down. It's an organic movement of price, all right? And it moves around up and down all day. And the price movements are not random, although they might seem like they are, but they're not. Every price movement happens for a reason. And again, getting back to what I just told you, when there's enough people on the wrong side of the market, that gives incentive for the market to move against that side. So getting back to kind of why this is important. You know, when you look at a traditional price chart, okay, this could be an example of a traditional price chart. Just ignore what you see on the left here. You're basically seeing one thing. You're seeing if the price moves up or down. That's it. That's all you see. You can see patterns forming that, in my opinion, are pretty much arbitrary. So you can say, you know, typical chart patterns increase the probability that the market will move in a direction. For example, if you see the market making higher lows and higher lows, you could say that the market is generally showing a sign of strength, because every time it moves lower, it creates a higher low. It's unable to push the previous low. But again, from a logical standpoint, that pattern, it's not really based on anything other than what it's been said to describe, if you know what I mean. So therefore, it's arbitrary. It doesn't really mean that just because the market's making higher lows, that it's strong. You have to understand the greater context of it. And in my opinion, when you're able to see orders at price, in this case, and volume at price, that's what I mean, you're able to gauge the context a lot better, in my opinion. So I'm not speaking because I think this is better and this is what you should do. I'm just speaking from my own experience, is that you gain an edge by looking at orders hitting the market in real time at the prices that you're watching, right? So if you don't see the tape, all you can see is if the price goes up or down. You can't necessarily see how many contracts are hitting into that price and if the price is moving higher or lower on those orders. And that is very significant information, in my opinion. Because, you know, if you see a lot of buyers hitting into the market aggressively, but the price doesn't go up, you shouldn't be buying. And again, it depends on the greater context, but that's where tape reading starts to make sense. When you look at the market and you see buyers buying, is the price going up or is it not? Basically, there's three things that can happen. So I'll give the example. Buyers are hitting the tape, right? You see your tape's all blue or green in whatever color you have it set to. The price can either go up, it can either not do anything, or it can go down. You'd be surprised. I've seen buyers hit the market and the price goes down. So all of those three outcomes tell you different things. You cannot see that on a chart. Do I need to say it again? Now, I'm not trying to hate on charts here because charts are very useful, but you need to use them for what they're useful for, all right? So when I look at charts, I look at this, okay? So we see a 30-minute chart, for example, but we do in fact see volume at price. Again, volume at price will be probably one of the most important things that you need to look at in the market to gauge the perspective of traders on the long side and the short side, all right? So when you're reading these markets, you can't be sitting there thinking, I want to buy or I want to sell. You need to see the perspective of traders that are buying and traders that are selling. Just kind of watching the game. Your goal is to just watch the game based on the information that you've gained from observing the game. You start to develop an idea of who is more likely to win in the short term. And that is essentially where the edge is in watching order flow, okay? Looking at order flow. The edge in understanding order flow is basically, like I said, trades and orders at price and orders in real time at price that are adding to the accumulated orders at price. So orders at price, fine. That's all I need to say. So guys, if you gained some value from this video, feel free to check out some of the other videos on the channel, and I will catch you guys in the next video. Take care. Bye.